Here is the number they do not put in the pamphlet. When your spouse dies and you file your first tax return as a single person, the 12% tax bracket for a married couple runs all the way to around $96,000 of taxable income. In 2026, married couples filing jointly do not reach the 22% tax bracket until taxable income exceeds $100,801. A single filer hits that same 22% rate at $50,401. Half, exactly half the bracket width. Same accounts, same IRA, same Social Security check, one person dead. The effective rate on every dollar above that line just doubled. And that is before the Medicare premium surcharges arrive on a 2-year delay, before 85% of the surviving spouse's Social Security check becomes fully taxable, before the standard deduction drops from $32,200 for married filers down to $16,100 for the surviving single filer. 3 separate blades dropping simultaneously. And there is a fourth blade I am going to show you today that most CPAs miss entirely, one that involves a brokerage account you think is perfectly fine, but is actually a ticking tax bomb that detonates based on a titling decision you probably made without realizing what you were agreeing to. The trap has a name. It is called the widow's penalty. It describes survivors who earn less as a household yet land in steeper effective tax territory after losing the married filing jointly benefits. The reason you have probably never heard it explained in plain math is that the financial advice industry is not structurally rewarded for explaining it. Advisors get paid on assets under management. They do not get paid to restructure your account titling before the funeral. They do not get paid to model what your surviving spouse's tax return looks like in year 2 after you are gone. So they do not do it. And by the time the CPA calls with the news, it is too late to reverse anything that matters. What I am going to do for the next 20 or so minutes is walk you through 4 specific asset categories that need to be repositioned before the first spouse dies, not after, before. Each one, in its default configuration, feeds the widow's penalty machine. Each one, restructured correctly while both spouses are alive, can be diffused. I am going to give you the specific mechanisms, the actual tax code provisions, and the math to prove every claim I make. Think of the American retirement system as a stage built with a hidden trapdoor. While you are a couple married, filing jointly, you stand on solid ground. The floor holds. But embedded directly beneath your feet is a mechanical latch. When one of you dies, someone in Washington pulls a lever you never knew existed, and the trapdoor drops. And every dollar you saved for 40 years starts falling through into a tax environment that was quietly rebuilt while you were busy living your life. 4 assets, 4 latches. At least one of them is probably open right now without you knowing it. I want to start with the asset that surprises people the most. Not the IRA, not the pension. The one that almost every CPA gets exactly wrong when one spouse is aging or in declining health. Your taxable brokerage account. In a few minutes, I am going to show you exactly how the IRS has built a permanent income extraction mechanism inside a traditional IRA, and how aggressive Roth conversions are the only tool that dismantles it. But first, here is something about the account sitting at Fidelity or Schwab or Vanguard that most advisors actively tell people to do wrong. There's a woman I want you to picture. Her name is Margaret, 66 years old, Columbus, Ohio. Her husband Frank was a structural engineer. They were methodical, sensible people. 38 years of index funds and automatic reinvestment, no speculation. By the time Frank was diagnosed with Parkinson's in 2024, they had a taxable brokerage account worth $720,000. The original cost basis, what they actually paid for the positions over the decades, was $240,000. The embedded capital gain sitting inside that account was $480,000. Margaret's accountant, meaning well, told them to start gifting appreciated shares to their adult children to reduce the taxable estate. Frank signed the paperwork. They transferred about $60,000 worth of positions with an original basis of $20,000. This was the single most expensive financial decision of Frank's remaining years. Here is why. Under Section 1014 of the Internal Revenue Code, if a person holds property at death, it receives a new basis equal to the fair market value on the date of death. In the case of appreciated assets, the rule allows people to inherit stocks or real estate without inheriting the tax burden triggered by capital gains. So if Frank had simply held that fund until he died and left it to Margaret, she would have inherited it at a fresh cost basis equal to the market value on his death date. Zero capital gains tax on $480,000 of embedded gain, vaporized, legally, permanently erased by the federal government. This is why gifting highly appreciated property can unintentionally transfer a large future tax bill to the recipient. Inheritance often reduces or eliminates that bill. Margaret's accountant was solving the wrong problem. He was reducing the estate with one hand while creating a massive capital gains liability with the other. You think the problem with a brokerage account is managing volatility. Actually, the problem is titling and timing. That is the reversal. Now, here is where this gets genuinely interesting. In a separate property state, spouses do not have equal claim over income or property acquired solely in one partner's name. When one spouse dies in a community property state, the living spouse receives a full step-up in basis on both ownership portions of all jointly owned assets. By contrast, a living spouse in a common law property state would only get a step-up on the deceased partner's portion of ownership. The IRS lists Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin as community property states. If you live in one of these states, both halves of your jointly owned brokerage account step up to fair market value when the first spouse dies. All of it. Zero embedded gain on the entire position. In common law separate property states, surviving spouses that owned property jointly with their late spouse generally receive a step up in basis on 50% of the joint asset, not 100%. 50. The other half stays stuck with the original cost basis from whatever year you bought the fund. Same account, same death, different state, a difference worth tens of thousands of dollars in capital gains tax owed or not owed, based entirely on a titling decision nobody told them to revisit. By the way, hit subscribe if you like the content, otherwise the algorithm may never show you my videos again. YouTube's machine does not know the difference between a retirement education channel and a day trading hype account, so it needs a little signal from you. In a community property state, confirm your accounts are registered as community property with rights of survivorship, not just joint tenants with rights of survivorship. In a common law state, a joint revocable living trust with specific community property language can in some cases replicate the treatment. Alaska actually has an opt-in community property system for couples who want to elect it. This requires an estate planning attorney, not a generic CFP. The strategy exists, it is legal, it is sitting in the tax code, and most advisors will never bring it up because nobody pays them to optimize account titling. The trapdoor under your brokerage account is the title, not the investments inside it. Now, the IRA. And I want you to understand something before I get into this, because I need to correct a framing error that most financial content makes. You think the IRA problem is the required minimum distribution. The RMD is annoying, the tax is real, the math is irritating. I know, but the RMD is a symptom. The disease is one level deeper, and it is this. The traditional IRA is fully taxable income at withdrawal, and the rate at which it gets taxed changes dramatically the moment one of you dies. The account does not change. The money inside does not change. The tax environment it lives inside changes violently. Let me show you exactly how. A married couple, both 69, Denver suburb, has $900,000 in a traditional IRA. The husband's rolled over, 401k mostly. Their combined Social Security is $58,000 a year. Small pension, $15,000. The RMD calculated using the Uniform Lifetime Table Divisor for a person near age 75 is around $30,000 or higher. Let us say $31,000 for this couple. At 69, total gross income, $104,000. Married joint, After deductions and the new senior bonus available under the One Big Beautiful Bill, they are paying largely at the 12% rate. Manageable. Then the husband dies. The wife is now a single filer. She keeps the higher Social Security check, hers or his, whichever is larger, but she loses the other. Household Social Security drops from $58,000 to around $36,000. The pension had a 50% survivor benefit, so it drops from $15,000 to $7,500. But the IRA balance is still $880,000. And the RMD does not care about any of this. The RMD does not care about grief. The RMD does not care that she only needs $12,000 a year to cover the property taxes and the groceries. The Uniform Lifetime Table forces out $31,000, actually slightly higher each year as she ages and the divisor shrinks further. Her gross income as a single filer, $36,000 in Social Security, $7,500 in pension, $31,000 in RMD, roughly $74,500. She makes less money than the couple made. She has less income. And yet, to make matters worse, the standard deduction the widow receives is almost cut in half. In 2026, for a married couple, both over 65, the standard deduction is $35,500. A single filer over 65 has a deduction of only $18,150. So the income drops, the deduction collapses, and the dollars that would have fallen inside the 12% married bracket now face a marginal rate that roughly doubles. And then the Social Security torpedo hits. For married filing jointly, Social Security benefits become 50% taxable at $32,000 of provisional income and 85% taxable at $44,000. For a single filer, those thresholds drop to $25,000 and $34,000. She crosses them immediately. 85% of the Social Security check her husband paid FICA taxes on for 38 years is now federally taxable income. Because she is alone, well, can't she just spend less? If she does not need the RMD money, can she just not take it? No. The required minimum distribution is not optional. It comes out of the IRA whether you spend it or fold it into a savings account. The IRS computes it on the balance as of December 31st, and you take it or you pay a 25% penalty on the amount you missed. The income is forced whether you want it or not. That is the crossfire, a forced income mechanism firing into a compressed single filer tax environment for the rest of her life. The mechanism that closes this trapdoor is aggressive, systematic Roth conversion while both spouses are alive and the joint brackets are wide open. The IRS allows joint filing for the calendar year in which a spouse dies. That window is the cheapest Roth conversion opportunity the surviving spouse will ever see. Filling the 12% and 22% joint brackets with conversion dollars before December 31st of the death year locks in lower rates on money that would otherwise be taxed at 22-24% as a single filer for the rest of her life. But you do not want to wait until the death year. You want to start years earlier. For a married couple with limited other income in 2026, the Roth conversion capacity in the 12% bracket alone is approximately $133,000 at a blended effective rate of about 10%. Do that over 5 or 6 years, converting methodically, staying inside the 22% married bracket. You pay the tax now at the wider rate. The money moves to the Roth, and when one spouse dies, the survivor inherits a Roth IRA with no RMDs, ever. No forced income. No taxable withdrawal, no Social Security torpedo, no IRMAA trigger. The widow's penalty machine has been starved of its primary fuel source. Tax-free compounding over 20 to 30 years is enormously valuable regardless of future rate changes. A $100,000 conversion growing at 7% for 25 years becomes $542,000 of completely tax-free money. That is the math. Pay the tax once at a known rate. Eliminate the tax permanently on every dollar of future growth. Here is the part that never makes it into a standard retirement calculator. Knowing the widow's penalty exists and knowing how to build a system around it are two entirely different things. I spent months pulling together 50 years of actual retirement data, withdrawal rates, sequence of returns risk, the mechanics of Social Security timing, the IRMAA cascade, and exactly the kind of bracket math we are walking through right now, and I built it into a digital book called The Exit Code. 8 chapters of research, no filler. There are 2 pieces of it that connect directly to what I am explaining today. The first is the dynamic withdrawal method, a calculation that replaces the 4% rule with a framework actually calibrated to your filing status, your bracket exposure, and what sequence of returns risk does to a surviving single filer drawing down a traditional IRA. The 4% rule was designed in the 90s for a married couple with a diversified portfolio. It was not designed for a widow filing single in the 22% bracket with an IRMAA surcharge on her Medicare. The second is what I call the 58% rule and the buffer strategy, the math behind how many households get forced into financial decisions during widowhood, not because of the tax code, but because they had no liquidity buffer and got squeezed by the combination of lower income and higher taxes arriving at the same moment. The exit code walks through that scenario in detail with the numbers. You can get it for less than a single dinner out through the link in the description. The year you delay starting these Roth conversions is a year the IRS gets to compound inside a tax environment it controls, not you. Now, let me tell you about Gary. Gary is 64 years old. He retired from a regional power utility in 2023. His wife, Susan, is 62. They have been together since college. Gary has a defined benefit pension. When he retired, he sat in a conference room with an HR specialist and a benefit election form. The specialist explained, pleasantly and efficiently, that Gary could take the full pension, $3,200 per month, as a single life annuity. Or he could elect the 50% joint and survivor option at $2,850 per month, which would pay Susan $1,425 per month after Gary dies. Or the 100% joint and survivor option at $2,600 per month, with the full amount continuing to Susan. Gary looked at $350 per month between single life and the 50% survivor option and took the higher check. He figured his investments would cover Susan. He signed the spousal waiver. Susan signed because Gary had always managed the finances, and she trusted his judgment. Financial planners have documented clients making the mistake of electing the single life option because it was the highest monthly payout, only to have the pensioner die unexpectedly at an earlier age. It is a devastating financial event for the surviving spouse because the pension payments stop. Just stop. Gary does not know his expiration date. Nobody does. And 80% of men die married and 80% of women die single. That is not pessimism. That is actuarial reality across the entire American population. The pension trapdoor, once you have already retired on single life, cannot be reopened. The election is locked. But here's a strategy that has existed for 4 decades, and most mainstream financial media skips entirely: the pension max approach. One common strategy is to choose the single life annuity and buy life insurance to protect your spouse using some or all of the difference in benefits between the higher paying single life annuity and the joint and survivor annuity to pay the premiums. Gary's $350 monthly differential is $4,200 a year. That funds a meaningful life insurance policy on Gary's life. When Gary dies, the death benefit reaches Susan. She uses it to purchase an immediate income annuity or simply invests it, and the death benefit is income tax-free under Internal Revenue Code Section 101A. Tax-free, no bracket exposure, no IRMAA trigger. Compare this to what would have happened under the joint and survivor election. Susan would have received $1,425 per month, fully taxable as ordinary income, stacked on top of her Social Security and RMDs, pushing her further into the single filer bracket squeeze. The pension max strategy converts a taxable survivor income stream into a tax-free death benefit used to fund a tax-free income stream. 2 critical caveats. Gary needs to be insurable life insurance. Underwriting requires relatively good health, which is why you run this analysis before retirement, not 5 years after a diagnosis arrives. And the math requires an actual insurance quote. not an estimate. Run it before you sign the election form, not the week before the HR deadline. For anyone pre-retirement, if you are married, most pension plans require your spouse to formally waive the joint and survivor option before you can elect a single life annuity, which means both of you are making this decision. Make it together with the actual survivor income numbers in front of you, not in a conference room with an HR clock ticking. Now, the fourth asset. This one runs so quietly in the background that most retirees never notice the damage until the Medicare letter arrives. Stay with me here, because this next mechanism shows how an asset class you have always considered boring and safe is actually one of the widow's penalty machine's most reliable fuel sources. Here's what I mean. A retired couple holds $200,000 in bank CDs and treasury bills, yielding around 4 to 4.5%. That is roughly $8,000 to $9,000 of interest income hitting the 1099 every December 31st. While both spouses are alive and filing jointly, there is no IRMAA surcharge until joint filers reach a modified adjusted gross income of $218,000. They are nowhere near that. No surcharge, standard Medicare rates. Now the husband dies. The same CD interest unchanged accounts, same rate contributes to the surviving wife's single filer Maggie calculation against a threshold that just dropped by exactly half. For 2026, IRMAA surcharges kick in for single filers with modified adjusted gross income above $109,000 and for married couples above $218,000, according to the Centers for Medicare and Medicaid Services. If her RMD income plus Social Security plus CD interest crosses $109,000, the Medicare premium surcharge activates, and it activates on a 2-year look back. The penalty for income earned in 2026 hits her Medicare bill in 2028. The delay is specifically long enough that most surviving spouses cannot connect cause to effect by the time the higher premium arrives. Here is the comedic part of this, if comedy is the right word for watching someone's retirement slowly evaporate. The financial press spent years telling retirees to chase yield. Lock in the high CD rates while you can. And for a married couple in low bracket territory, that advice was fine. But not a single article I saw included a line that said, by the way, every dollar of CD interest you earn this year is also MAGI for IRMAA purposes, and when one of you dies, the threshold you need to worry about just got cut in half. Because that line does not generate clicks, it generates work. 3 solutions, 3 different states. First, high quality in-state municipal bonds. Interest from in-state munis is exempt from federal income tax under Internal Revenue Code Section 103 and also exempt from state income tax. California, with a top state income tax rate of 13.3%, makes California-issued munis extraordinarily powerful. A 5% muni yield in California can be the equivalent of a 7% taxable bond for a retiree in a high combined bracket. Florida has no state income tax, so the muni strategy loses the state layer, but the federal exemption still applies. Ohio residents get solid double exemption from Ohio-issued bonds. Texas, a community property state with no state income tax, works similarly to Florida. Second, a multi-year guaranteed annuity, an MYGA. This is essentially a CD inside an insurance wrapper. The interest compounds tax-deferred inside the structure. It does not appear on your 1099 each year. No annual taxable event. The surviving spouse draws from it strategically in low-income years, keeping the Maggie away from the IRMAA cliffs and the Social Security torpedo thresholds. Third, properly structured cash value life insurance. Growth inside the policy is tax deferred. Withdrawals up to cost basis are income tax free. Any death benefit paid to the surviving spouse under Section 101A is income tax free. The widow's penalty can increase Medicare premiums because single filers have lower income thresholds for the income-related monthly adjustment amount. Cash value insurance eliminates the income that triggers those thresholds entirely. Now let me show you the before and after on a single household, because I want you to see the entire machine working or not working at once. Our Denver couple, $900,000 in a traditional IRA, $200,000 in a brokerage account, $15,000 in pension, $200,000 in CDs, Default settings on everything. Surviving spouse scenario, default. RMDs taxed at 22% single rate. Social Security 85% exposed to tax. CD interest pushing MAGI into IRMAA territory. Pension income stops because single life was elected. Over 15 years, the tax and IRMAA premium drag on this household runs somewhere between $200,000 and $250,000 more than it needed to be. Same couple, different architecture. They converted systematically over 6 years, $100,000 per year from the traditional IRA into Roth, staying inside the 22% married bracket. The brokerage account was retitled in a joint revocable trust, structured to maximize step-up treatment. The pension was elected as 50% joint and survivor, yes, $350 per month less while both spouses are alive. The CDs were partially restructured into state municipal bonds and an MYGA. Surviving spouse scenario, restructured. The Roth IRA has no RMDs. The Social Security torpedo thresholds are not crossed because provisional income drops significantly. Using the IRMAA example from 2026, where a couple comfortably avoided IRMAA filing jointly with combined income of $135,000, a surviving spouse with the same income as a single filer crosses the $109,000 IRMAA threshold, causing Medicare Part B and Part D premiums to rise. In the restructured scenario, that threshold is no longer crossed because the Roth income is invisible to MAGI. The brokerage account steps up in basis and can be liquidated without capital gains tax. The pension delivers a smaller monthly check, but it delivers a check. The muni bond income is federally tax exempt. The surviving spouse in the restructured scenario files in the 12% bracket. No IRMAA, no Social Security torpedo. Same people, same money, different math. Now, here is something I want you to sit with for a second. In the United States, more than 900,000 older adults are widowed each year. About 30% of women aged 60 to 74 are widowed, and over 40% of women aged 65 and older are widowed, compared to only 13% of men in the same age group. 900,000 people per year falling through a trapdoor that has been written into the tax code for decades. Between now and 2048, an estimated $54 trillion will pass from deceased spouses to surviving partners, and the vast majority of those surviving partners will be wives who outlive their husbands. $54 trillion. Moving into the hands of surviving spouses, and a meaningful fraction of it taxed at rates that would have been impossible had the right account restructuring happened while both partners were still alive. The money is there. The information to protect it is there. The tax code contains the escape hatches inside the same chapters that contain the trap. The window to use them closes permanently the moment the funeral home pulls out of the driveway. Let me introduce you to Gary's neighbor Dave, who also retired from a utility company and made every decision differently. Dave is 63. His wife Patricia is 61. About 6 years ago, they found a fee-only fiduciary, a planner who charges a flat annual fee, has no products to sell, and gets paid whether or not they recommend anything. They asked for one thing: a survivor scenario analysis. Model what Patricia's tax return looks like in year 1, year 2, and year 10 if Dave dies first. The advisor ran the numbers. They saw the bracket collapse. They saw the RMD crossfire. They saw the IRMAA cliff. And they started converting $60,000 per year from Dave's rollover IRA to a Roth, staying inside the 22% married filing jointly bracket. By the time this video went live, they had converted approximately $360,000. Dave's traditional IRA balance has dropped to a level where Patricia's projected RMDs as a single filer will land inside the 12% bracket even after Social Security is layered in. Dave also elected the 50% joint and survivor option on his state pension. His monthly check is $210 less than the single life option. He did not buy a separate life insurance policy. He bought the insurance inside the pension election itself, a guaranteed survivor income floor that does not require underwriting, does not require Patricia to do anything, and does not disappear if Dave's health changes. Dave is not a financial professional. He is not a genius. He is a guy who paid for a survivor scenario analysis and then did the work the analysis identified. That is the entire playbook. But my financial advisor has been with me for 20 years and has never mentioned any of this. I know. And this is where I land in amused disappointment rather than outrage. Your advisor has not mentioned this because the business model does not create an incentive to mention it. Advisors are paid on assets under management, running a survivor scenario, restructuring account titling, modeling Roth conversions for the widow's penalty. None of that generates a transaction or a fee event in the traditional commission or AUM model. It is invisible labor. So it does not happen. This is not a conspiracy. It is just an incentive structure working exactly the way incentive structures work. The system is not designed to protect your surviving spouse. It is designed to generate revenue on your assets. Understanding the difference is worth roughly $200,000 over a 15-year widowhood. 3 practical takeaways. And I am going to be specific because generic advice is useless. Takeaway 1, pull up the titling on your taxable brokerage account today. Log in. Look at how the account is registered. If it says JTWROS and you live in a common law state, Ohio, Georgia, Florida, New York, most of the country call an estate planning attorney this week and ask specifically about account titling for step-up optimization. Do not gift appreciated positions to your children to reduce the estate. Do not transfer them while both spouses are alive. Gifts of appreciated stock or real estate while the owner is still living typically retain the owner's cost basis. If instead the asset is transferred upon the owner's death, it gets a step up in basis, and the recipient is never taxed on the capital gain accrued during the original ownership period. Let the step up do its work when the time comes. The document you need is not in your brokerage app. It is in an estate attorney's office. Takeaway 2, model the survivor scenario this month. Take your current income sources, Social Security, pension, IRA, RMDs, investment income, and run the math as if one of you is gone. What does the single filer return look like? Does the surviving spouse cross the IRMAA cliff at $109,000 MAGI? If you have a CPA, ask them specifically, can you run a survivor scenario and model a Roth conversion strategy? That is the specific phrase. If they have never done this type of analysis for you, they are a tax preparer, not a tax planner. The distinction is worth $150,000 over a 15-year survival. Takeaway 3, check the pension election before it is locked. If you have not retired yet, you still have a choice. Get an actual insurance quote on the pension max strategy. Run the joint and survivor math with the real numbers. If the pensioner is already retired on single life and is still insurable, ask a fee-only insurance advisor, not a commissioned salesperson, to run the pension max analysis. For some households, it makes sense. For others, it does not. The math tells you which one you are. None of this requires you to be a tax professional. It requires you to ask the right questions of the right people while both of you are still at the kitchen table. The system works against you by default. Every default setting in the American retirement architecture, the traditional IRA, the joint brokerage account with the wrong titling, the single life pension election, the CD generating taxable interest, every default was calibrated for the government's maximum revenue extraction from the surviving spouse. The defaults are not neutral. They are expensive. Lazy investing built more fortune than crypto memes. And the single laziest, highest leverage financial move a married couple over 50 can make right now is to spend 4 hours with the right professional running the survivor scenario and then systematically implementing what the math says. The IRS is not waiting for you to get around to it. The trapdoor is already built into the floor. The only question is whether you moved your 4 assets off it before someone pulls the lever.